Recent tariff announcements by President Trump on April 2nd have sent shockwaves through the global markets, triggering significant market volatility driven by the uncertainty of these tariffs and their impact on global supply chains, inflation, and economic growth. As markets are grappling with various potential scenarios, how should investors be positioning their portfolios to navigate continued uncertainty?
We haven't seen these moves in many years where we saw a 36 basis point move in the 30-year Treasury. We've only had 8 instances of that in the last 25 years.
From a macro standpoint, a central question is how quickly the uncertainty disperses.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Coming up on The Bid, I'm joined by Purves, Global Head of Macro at the BlackRock Investment Institute, and Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas at BlackRock. Glenn and Gargi will help us navigate the current themes driving market dynamics, how these shifts impact supply chains and prices, and how investors can manage volatility and uncertainty in these turbulent times. Glenn and Gargi, thank you so much for joining us on The Bid.
Thank you for having me.
It's great to be back.
I should mention, we are recording this on Tuesday, April 8th, because there's been a lot going on in the markets, in the world economy, just in the last couple of days. And Glenn, if I could start with you, the last time that we spoke to you, it was the beginning of February. You were here with Catherine Kress, and we were talking about, at the time, the new tariff announcements. April 2nd came and went. We heard more news on tariffs from the Trump administration. So can you give us an overview of what these announcements were and what has been the impact on the macro landscape?
Thanks, Oscar, and great to be back. Yeah, a lot has happened since we were last here in February. The U.S. administration, they set out 3 components of tariffs since the last time we spoke. And the focus on April 2nd was really about setting out the key components. The first component is about strategic sectors and where the administration would like to reshore manufacturing capacity in the U.S. And this started with announcements not on April 2nd, but back when we last spoke in February. 25% tariffs on steel and aluminum, as well as auto assembly and parts, are in place right now. And we expect the administration to continue down the path for semiconductors, for pharma, copper, and lumber. The second component is a universal component for all countries. It's 10% broad-based tariff for all import, same level, applied everywhere. The third component is unique, and it's specific to over 60 countries where they have trade surpluses with the U.S., a surcharge tariff up and beyond the 10%, unique to each country. And this is being applied against many of the largest economies in the world. China, for instance, and Asia, in particular, given the size of some of their trade surpluses. And this third trade deficit component is quite idiosyncratic because while there's been some stated intentions by the administration that these can be negotiated down, the playbook on this really remains opaque at this date, which has spooked markets since April 3rd, creating a lot of volatility. From a macro standpoint, a central question is how quickly the uncertainty disperses, how this all plays out, and where this ultimately lands. And if what was set out on April 2nd holds, or something similar to this, then stagflation, meaning lower growth and higher inflation, seems unavoidable, and the risk of U.S. and global recession is much higher. To this extent, there are some parallels to March 2020 COVID and the world looking for signposts and signals for greater certainty.
You know, tariffs are nothing new in the long-term perspective of markets, but to have this much news around tariffs, this widespread across so many economies, and of this magnitude, all of that, though, does seem pretty unusual. So, Gargi, what has been the market reaction to all this news?
Sure, Oscar. And you and I have been in this room, talked about this before. Equity markets like certainty. And one of the things that Glenn talked about was this injection of volatility and uncertainty that's come about. And then you couple that with uncertainty around expectations of growth perhaps moving lower, expectations of earnings perhaps moving lower for companies. And what you have is a recipe for market turmoil.
Another roller coaster of a day on Wall Street, with the Dow losing another 349 points, the Nasdaq up slightly, and the S&P 500 down slightly.
The volatility on Wall Street comes as the future of global trade remains uncertain.
Market analysts say that it is what we should expect in the coming days and weeks ahead.
Right after April 2nd, when the markets responded, right after the news came out, you did see an immediate reaction to lower prices in stock markets in all parts of the world. And that continued on not just on Thursday, but also on Friday when we got the retaliatory effects from China, when we got that news. So a huge sell-off on that Thursday and that Friday, which was the biggest two-day rout actually since COVID in 2020. Monday was again another day when, at least globally, when the markets opened up on Sunday night, we saw some of that market continuation of that volatility, but we did see stabilization. And today, as you said, we're speaking on Tuesday, we have seen markets stabilized, and actually some dip buying come in the markets right now, as I left my desk, are up for the day. But I think that we're going to learn a lot more. So 2 distinct periods, lower first and then stabilization to a little bit higher. That's just equities globally. There's also been the bond market reaction, which I think has been fascinating, where right at first, on the Wednesday and Thursday, we did see bond yields go down at first. There was increased expectations of the Fed coming in and cutting rates, or at least that's what the market was pricing in. That held for maybe 1.5 days. And after that, there's been a very significant move higher in yields, especially in the long end of the curve. We haven't seen these moves in many years, where we saw a 36 basis point move in the 30-year Treasury, which was pretty meaningful. We've only had 8 instances of that in the last 25 years. So I think it's pretty meaningful. So bonds did go down, but actually didn't retain that move. Bond yields moved higher. Then we look at other parts of the market like commodities, where growth commodities like copper and oil have also come under pressure. One of the areas that's been a little bit of a silver lining, if you will, but it's actually gold, which has held in well for the entirety of this year. So that's been the initial market reaction, and obviously a lot more to unfold as we learn more.
You've actually talked to us about gold in the past when you've been a guest. I just want to go back to your comments on the bond market, which is in the initial parts of the sell-off, bonds rallied, bond yields went down. So there was that typical flight to quality. When investors are coming out of risk assets like stocks, they bought bonds. But you said more recently now bond yields are going up. And Glenn, maybe that ties to what you mentioned about stagflation. You said that one of the risks is that we could be in a period, if these tariffs persist, where growth slows and inflation goes higher, and that is not a good recipe for the bond market. So maybe you can talk a little bit more about how your investment views have shifted as you've digested all of this tariff news.
Sure. And I'll talk about silver lining as well with gold, because it ties in there as well. Given all the developments starting in April 2nd, we set out a bulletin on April 4th that changed our view on this. And what it sets out is that we see the current maximalist stance of the administration and the deleveraging market dynamics that Gargi walked through as keeping risk assets under pressure in the near term. But for how long or how short is also uncertain. That's why we've shortened our tactical horizon, and we're reemphasizing the first phase of our long-held view that things will get worse before they get better. And over this shorter horizon, we reduce risk in taking equity exposure to US, Japanese, and Chinese stocks to neutral. And instead, we're allocating more towards short-term US Treasuries, which could benefit as investors seek refuge from volatility. And we also allocate to medium-term Treasuries as well. Now, if clarity returns quickly, we look to re-risk, of course. And in terms of where we continue to be, we still remain underweight long-term Treasuries given persistent U.S. deficits and sticky core inflation even before any tariff impact, which links to the point that you made. And we still see gold as a better diversifier. As Gargi said, it's been a silver lining than longer term or longer duration bonds. But overall, this environment, it still favors security selection and taking an active approach with portfolios.
So, Gargi, what Glenn's saying is that the BlackRock Investment Institute tactically is reducing risk in portfolios and looking for more clarity. I know you spend a lot of time talking to investors during this period and helping them make sense of the volatility in the markets. What are you hearing from them? And what do you think we should be doing in terms of portfolio positioning? Because certainly we go through periods of market volatility. That's what investing in the markets is all about. Is this period different than other periods?
I'll pick up on the first point around market volatility all the time. And if you look over the last 75 years, the average intra-year market drawdown has been about 14%. This is to say that volatility is often always with us. Obviously, this time around, we did see the S&P 500 come down about 20% from its peak at one point on Monday morning, so maybe a little bit higher than that average 14%. But I think it's important to remember that drawdowns, even slowdowns in growth, are all a very normal part of a market cycle. Another question that's coming up a lot from investors is just around, is there panic out there? And how are things trading? And I want to make sure that our investors who are listening understand that as of right now, things are trading in a very orderly fashion. So when we look at volumes across ETFs or when we look at volumes that are trading in the various stock exchanges, those are hitting record numbers. And what that means, what that indicates to us, is that there's an exchange of risk transfer taking place, which is a healthy sign. As we're thinking about the market and how investors should think about the market, I think it's important to remember that if you invested about $100,000 in the market 20 years ago, that's about $717,000 today. But if you just missed 5 top performing days, that number is significantly lower, about $452,000. So despite volatility, staying invested, especially if you're a long-term investor with a long view on markets, I think it often pays off. Having said that, of course, if you are thinking in a more short-term or medium-term nature, this is volatility and there are changes to come. And a lot of clients have been asking me about our view on a recession and if that's something that they should be thinking about when it comes to their portfolio. And the 3 things that we're telling clients to think about is really, first of all, thinking about diversifying. Glenn talked a little bit about this around where you can go around different asset classes, but it's not just around different asset classes. It's also around US versus the rest of the world. It's around shorter term fixed income parts of the market, inflation-linked bonds, gold, market-neutral strategies that don't take a lot of equity market beta, for example. So adding that diversification. And then the second is defense within your equity portfolio. So obviously, many of your listeners and many people have some portion of their investments in equities, and that's what we're talking about in terms of volatility. So adding that defense within equities, so maybe thinking about more minimum volatility strategies that can reduce that volatility profile in your portfolio. And I think that's important in these times. And then number 3, broadly thinking about defense in your entire portfolio. So not just thinking about defense in your equity portfolio, but thinking about the defensiveness of the entire portfolio. And then this is where thinking about what are the diversifiers that have a negative or a zero correlation in your portfolio. So again, broadly having a diversification, US versus the rest of the world, having defense within equities, so minimum volatility as a strategy, and then having defense on your entirety of your portfolio, which is really thinking about things, again, like inflation-linked bonds, thinking about things like gold, thinking about things that can earn you income, especially in the belly of the curve, which we define to be the 3 to 7 year part of the curve.
And just tying both of your comments together, Glenn, you're saying that the BlackRock Investment Institute is taking a shorter time horizon right now to evaluate markets and maybe make sense to take down risk. And Gargi, you're saying be diversified. You can do that geographically or based on the types of strategies you use in your portfolios. But what you're both saying is stay invested, that this is still a prudent approach over the long term is to stay invested. But having said that, Gargi, just maybe one more thought, which is what are maybe inflection points or signs that you're looking for that were coming out of the storm that would start to get you more constructive? And Glenn, please feel free to chime in here as well.
Yeah, so you heard about the Ds, and now we'll talk about the Rs. So a few things that we're keeping our eye on, whether that comes to turning more defensive or even more constructive. The first is certainly just reaction from countries, and we obviously have heard some news around that from China, and there's talk about others maybe coming soon. There's a question about recognition of where tariff rates end up landing. So what might that look like? And then I think thirdly, and this is probably the most important one as we think about the path ahead, is response from both companies and from monetary policy. So if growth significantly slows, is the response from the Fed, for example, to cut rates, or are they not able to because inflation is sticky enough that they can't look through that? So that is a response that I'm keeping in mind. Response from companies is really important. Most immediately, my focus will move to the earnings season that's coming up. Just at the end of this week, we're going to start getting the first look at Q1. And as we've seen historically, about 20% of companies provide quarter-ahead guidance on earnings call, and about 43% provide full-year guidance. So to what extent are we finding that companies are not able to provide guidance at all? And we saw a little bit of that during COVID. So that's something I'm watching for. Obviously, any kind of negotiation or pushback around reciprocal tariffs, any kind of delay, I think that'll have a market reaction. But broadly, the 3 Rs, so recognition of where tariffs land, reaction from companies, and most importantly, the response from corporations as well as monetary policy. That's what I'm thinking about holistically as I think about how investors should be thinking about this market space.
And Glenn, what about you? Like, what are some of those signposts that you're looking for that starts to change some of your sentiment?
Gargi mentioned a lot of them. Like, I would say deals with countries and confirmation of retaliation intent. I think that's a big one. Status of lawsuits currently in the system. And the other one is the extent of economic damage as a consequence of the lack of certainty, and stakeholders and how the response mechanism occurs to that. I think that's going to be very important to watch. Like Gargi mentioned, the Fed. The role of the Fed isn't to clear out uncertainty. It's to provide price stability and full employment. And in the case of the Fed, I think they're going to be in a very difficult spot due to the sticky inflation that Gargi mentioned that already existed even before these tariffs came in place. The only thing I would add to this is I think we got to keep in mind that it's not just a tariff story. It's not even just a trade story. And I thought Stephen Miran, the chair of the Council of Economic Advisors for the White House, put it very clearly this week when he said that the underlying objective is greater cost and burden sharing on security and trade between U.S. and partners. And in his words, that means other countries accepting tariffs on their exports to the U.S. without retaliation. It means stopping unfair trading practices by opening markets and buying more American. It means investing in and installing factories in the U.S., and it means boosting defense and security spending and procurement from the U.S., which we've seen in Canada and Mexico thus far, and Secretary Rubio is seeking higher NATO contributions and commitments of up to 5% of GDP. And whichever way you see it, it means foreign governments, households, and businesses spending more. And that kind of fiscal expansion, it feeds into this global rates resetting higher momentum that we've been seeing even before the U.S. administration kicks in. So some of the growth advantages that you could see emerging may be more delayed. And in the near term, as a consequence of tariffs, I think you're seeing more stagflationary impacts. And the question is really going to be how big it's going to be.
So part of what you're saying is that tariffs are in the news right now. That's what everybody's focused on. But this is part of a broader, longer-term shift in U.S. foreign policy, U.S. trade policy that's going to have implications far beyond the next couple of days.
Exactly.
So Glenn and Gargi, we know you've had a busy week already. And as we said, it's only Tuesday, but we appreciate you sharing kind of real time what's going on in terms of tariffs, how it's impacting the markets, and what investors should be thinking about here in the near term. Thank you for joining us here on The Bid.
Thank you for having me.
It's great to be here. Thanks so much.
Thanks for listening to this episode of The Bid. If you've enjoyed this episode, leave a review and share with a friend. And if you want to keep up with what's happening in the economy and the latest market trends, make sure to subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.